Thanks very much. Can you hear me okay? Or? This was my first visit here to Kalamazoo in Western Michigan, an expansive campus, and I was helped somewhat by the hurricane winds behind me this morning. Hopefully my talk won't be quite as breezy, and maybe not quite powerful, but I hope this will keep your interest and attention. The topic is extremely wide-ranging, and it really has to do with understanding the position of Africa in the world of global finance. The paper was originally, it's a commissioned paper from the Cambridge New Thinking in Economics, last April. It will appear next year in a volume on international political economy papers, co-edited by Perversities of Cambridge University and Malcolm Sawyer from Leeds University. So it's an attempt to kind of look at a wide range of subjects. So there's a lot of area to cover. I'm happy to go into more depth as we sort of go forward in various subcomponents. Basically, mainstream economists, neoclassical economists, basically inside the and outside of the international financial institutions, the 80s and 90s, pushed for an unfettered movement of capital flows, with the underlying belief, I don't have a lot of time to get into the theory today, but that funds would flow from rich countries with low marginal productivity to poor countries with high marginal productivity. With it would be enormous gains in investment, production, productivity, standard of living, by embracing this financial globalization. And so based on that, African countries removed restrictions on capital accounts, opened up the foreign direct investment, privatized state assets, including selling many banks off to foreigners, built stock markets, accumulated reserves, all under the encouragement of the international financial institutions, their supervision, their finance, their expertise. Unfortunately, though, the promised gains have not been realized, and I'll talk about that today. What you had is this kind of opposite movement in which funds flowed from the poor African countries to the rich. Now, this has been recognized in some of the mainstream literature, including back as early as 1990 by Lucas, known as the Lucas paradox, pointing to this phenomenon. And there's a really huge literature on this that looked at everything from labor productivity differences to marginal productivity of capital, introducing human capital into total capital measures, differences in sovereign risk, property right issues, etc. All of them have a single common belief that once an impediment or two are addressed, this kind of neoclassical economic vision will occur as predicted. Now, the paper in this talk rejects this premise in favor of one that points to a much more systemic explanation that focuses on the basic power asymmetries in the structure of international flows. Yes, it's important for economists to understand the whole nature of power and the influence it has in the world, even more so today with growing income inequality. And so we witnessed, I would argue, a kind of 3-decade project in creating a system which one could refer to as the global financial imperative. Among that is first the attempt to commodify all products or services that have any utility. In other words, put a market price on it, control it to the market. Second is the financialization or attempt to reduce all value that is exchanged, whether tangible, intangible, future, present promises, etc., into a financial instrument or a derivative of a financial instrument. And the third is to allow for the unfettered movements of capital flows worldwide, private financial institutions and their products, through the demobilization of nation-states' capacity to impede or restrict the operation of these institutions and organizations, so they have a common platform of accessibility. Now, what has happened increasingly is domestic capital flows everywhere become part of global flows and are tapped as component parts of the accumulation strategies of large financial corporate organizations and their wealthy clients. Increasingly, what we've seen is, I'll talk today, the official and private flows are blurred and very closely interconnected. Now, financial liberalization and its associated legitimizing theories have been embedded basically into the international aid community now for decades. And they have used their power and resources in Africa and elsewhere to really alter the terrain for global capital with what I call perverse consequences. When we talk about perversion, we're really talking about a kind of ethical ideal, and it's very different than the kind of paradox which Lucas of the neoclassicals talk about. In other words, the outcome is not surprising in some senses, but it's not ethically, it's not one which is very ethically present. In fact, given the nature and the structure of power we'll talk today, it comes out in that particular way. So we're really talking about this whole ethical perversion where the poorest in the world are financially supporting the wealthiest, where capital flows have pushed African economies into perverse economic structures, where human needs everywhere have become subservient to the whim of accumulation strategy of hedge funds and wealthy clients, and where debt generation has fueled massive capital flood. Now, these are not just elements of rhetoric. I will illustrate all of these with good empirical foundations underlying this dynamic that's going on. So what do we mean by the financialization of commodities? We take an very good UNCTAD study in 2011. The mid-2000 mark the start of the trend of steeply rising commodity prices accompanied by increasing volatility. The prices of a wide range of commodities reached historic highs in nominal terms in 2008 before falling sharply in the wake of the financial economic crisis. And since then, we've seen a very rapid rise in commodity prices. And so what we see now is not only increasing volatility by any measurements, but also a rise in commodity prices, a very steady rise during this turning point after about 2001, 2002. And this correlates very closely with what has gone on in terms of the nature of the financialization of resource markets. Now, possible causes of volatility and rising prices have been looked at by the UNCTAD studies and others, such as rapidly growing emerging economies, growing urbanization, growing middle class, with changing dietary habits, including an increased appetite for meat and dairy products, the expansion of biofuels, conversion of land use from crops for biofuel production, the impact of climate change. And the study examines all aspects of this, and they argue that there is insufficient evidence that any one or all of them together can explain the huge change in prices of commodities or the huge and growing volatility. And from their perspective, the growing role has been the financialization of commodity markets. What it has to do basically is, it's a phenomenon basically that has to do with the activities of financial participants in the commodity markets, which drives prices away from the fundamentals, market fundamentals of supply and demand, with negative effects to both producers and consumers. The term they refer to as the financialization of commodity trading indicates the increasing role of what we refer to as financial motives, financial markets, and financial actors in the operation of commodity markets. At the very heart of the global finance is managing of vast resources and wealth from growing concentration of resources in hedge funds. And I'll show you what's happened with the numbers that have gone into hedge funds in recent years, run by very large, very profitable global financial conglomerates. So we just look at financialization of commodities. We look at the activities of hedge funds. In 1995, there was a pittance, a very small number, only mere 2,800, managing 2.8 billion of money. By September 2002, this number is now at $2.8 trillion in hedge funds, a huge increase in numbers, particularly since 2004, 2005, basically a doubling since 2006, with a slight drop-off and then an increase, and something in the area of closer to 10,000 hedge funds now managing this massive wealth. And the flip side of this, of course, is the growing concentration of wealth in the world and the huge profitability. So if you look at the impact this has had on futures and options contracts, what we find is just a massive increase as these numbers begin to grow in this period, a huge increase in the number of futures and options contracts in commodity exchanges between 1993 December 2010 from DAAS data. And you can see also a very large number in the amount. So the amount actually then, at its peak in 2008, it's something around $14 trillion, up from well below $1 trillion earlier in the decade. Now, increasingly what's happening then is the commodity markets are being driven not by the end users, as I suggested, but other factors. For example, the view that commodities are a good hedge when the value of the dollar falls, which lowers the value of global commodities in non-dollar terms. So it's part of a broader strategy of accumulation for these wealth funds. What has also happened is, as Keynes pointed out, is the notion of herdism, this growing tendency of individuals to mimic the action of larger groups rather than acting independently based on their own information. And so what has happened is very rapid movements in and out of markets with terrible consequences to people. And it's not just oil, it's also food. And this is what is so disturbing. It's estimated that 61% of the wheat futures in 2011 were held by speculators compared to only 12% in the mid-90s prior to deregulation. Now, what has happened basically is this big debate now over the issue of the relationship between large inflows of speculative money and their impact on the volatility in rising prices. And there is, of course, even among some progressive economists, a lot of skepticism about the underlying relationship. So, for example, how can futures markets have an impact if people are not actually receiving the goods? And even Krugman made a comment in 2008, a futures contract is a bet about the future price. It has no zero, not a direct effect on the spot physical price. But what is happening now is growing evidence and good research that is suggesting otherwise. What are some of the transmission mechanisms? First, what we find is traders in physical markets use futures markets as a benchmark to bid on options. So it's particularly powerful when prices are rising. And the question will be, well, wouldn't this lead to higher inventories as suppliers held product off the market? No, because what we find is it has an effect both on both sides' expectations. The price buyers are willing to pay, the price sellers are willing to sell, and therefore short-run elasticities are low. So there's actually a little impact on the quantities, only the price. And so one of the examples you have during this study by Worthy in 2011 clearly shows that what you have is little change in supply and demand, but in fact a tremendous rise in prices of commodity of wheat. Other links. While there's widespread evidence that the prices of long-term contracts for physical delivery of products are set in futures price markets. And so there's also very strong evidence of arbitrage in spot and futures markets. Now, a lot of this I can do an individual talk on, but it illustrates some of the growing linkages between the futures markets and the spot market. And what we see, of course, is this very, very disturbing trend. It's not just oil, it's also food prices. This very, very rapid rise in food prices that's occurred when the speculative money is increasingly going into food. And it has huge implications to the relationship between food price inflation in Africa and the level of international commodity prices of food. And we see elasticities as high as greater than 1 between international prices and local market prices in sub-Saharan Africa. And you have to understand how incredibly close, often to subsistence, the basic survival, basic nutrition, millions and millions of people are. So when the price goes up very slightly, what it has is huge implications to human security, a vast number of people on the level of calories they're able to get with their existing budgets. And so we've actually seen those prices more than doubling over the decade from this huge inflation. And you can see this on average, 1% increase in national food prices leads to about a 33% increase in local prices in Africa. Now, what has happened increasingly is this kind of complete cutoff from any sort of ethical consequences of understanding his relationship. So there's a wonderful quote from this trader on the floor of the Chicago Board of Trade who says, "This is capitalism in its purest form," the commodity expert raves. "This is where millionaires are made. How he makes money doesn't make any difference. There's no distinction between petroleum, silver, or food. I don't believe in politics. I believe in the market, and the market is always right. How does he feel about exploding food prices? It shows you how disconnected they are from the rest of the world. He says, the age of cheap food is over. Anyway, most Americans eat too much. So it has a beneficial effect. And so this complete disconnect from the reality of what goes on in other parts of the world is extremely disheartening. So, what about the relationship between orthodoxy and kind of the tendencies of African liberalization? What are the other types of perversities we're getting in Africa in terms of global flows? We know in the extreme version of neoclassical economics, we have perfect information, no transaction costs. Once impediments to the free capital mobility are removed, funds are seen to flow from low marginal product capital to rich countries to high marginal product capital to poor countries, as the capital markets go about in this world to equalize risk-adjusted marginal products of capital across borders. There's a long literature through this I don't have time to get through. And so it's claimed that financial globalization, basically as it proceeds, it improves the efficiency in global resource allocation, while developing countries emerge as a winner, benefiting from higher investment and consumption with lower interest rates, as well as from the opportunity of global risk sharing. So this is precisely the attitude that prevailed in the International Monetary Fund, where just prior to the Asian crisis in 1997, they were considering having open capital accounts as part of the prerequisite for being a member of the IMF. So they're going to write it into the Articles of Agreement. With open capital markets, you cannot be a member of the IMF. And the argument from Stanley Fischer, at that point, the second in command of the IMF, was simply free capital movements. It was right out of the neoclassical literature. Free capital movements facilitate a more efficient global allocation of savings, help channel resources into the most productive uses, thus increasing economic growth and welfare. So from the individual country's perspective, the benefits take the form of increases in both the potential pool of investable funds and the access of domestic residents to foreign capital markets. And just as current account liberalization promotes growth by increasing access to sophisticated technology and export competition has improved domestic technology, so capital account liberalization increased the efficiency of the domestic financial system. So this was the underlying ruling notion of the demobilization of the constraints and policies in place to limit the flows of capital in Africa. So these neoclassical formulations in mind, partially through conditionality, the IMF and other donors pushed the movement towards all restrictions on the capital account. And so, for example, first came the stock markets. It was an idea that if you build it, they will come, right out of the cornfields of Iowa. And so you had only 3 stock exchanges in 1980 in sub-Saharan Africa. By 2011, there were 22 stock exchanges covering 31 countries in sub-Saharan Africa. Most were organized after the Asian crisis, when the logic of capital account liberalization came into question, even within the International Monetary Fund, when they said, well, maybe this idea of making open account as part of the Articles of Agreement is a bit premature based on the crisis that happened in 1997 in Asia. So in all, exchanges covering 21 countries in Africa were established in 1997 and after, with support often of foreign assistance. And what has happened increasingly is there are very, very few restrictions on the foreign purchase and sale of stocks. So for example, one of the biggest in the world is TRO, Prices Africa Middle East Fund, which lists investment in stocks in 12 sub-Saharan African countries. In addition, we'll come back to that, but basically, what has also happened is a kind of push towards the uniformity of regulations and the diminishing regulations on the restrictions of FDI, basically pushing countries into privatization and very minimalist types of legal frameworks restricting the activities of FDI, pushing countries to follow their stated comparative advantage, which inevitably in Africa is resource extraction. And so a particular emphasis was over reforms in this vision aimed at attracting FDI, particularly into the mining sector. The standard that was used came out of kind of the shock therapy doctrine of Milton Friedman and company in Chile, basically A key document was the 1992 World Bank document on mining, which basically said Chile has been the most successful of the countries surveyed. The economy is completely free. There are virtually no restrictions on foreign exchange. Foreign investment is permitted under general legislation. There's no discrimination between local and foreign ownership. Neither is there a specific law governing investment in mining rights, with all the attributes of property rights being freely mortgageable, transferable, protected by the Constitution against confiscation. Effective taxation rates are the lowest of all the countries studied. So this is the kind of neoliberal dream for FDI, and it had a huge impact on the Ghana Mining Act of 1986 and 2006, both developed very closely with the World Bank, and it became the standard over and over in documents in countries pushed by the bank throughout Africa as they began to redesign FDI restrictions on mining. And so what's happened also is the flip side, of course, is that as you build these stock markets, the main interest, of course, is in resource extraction. And so what you find when you look at these stock market listings, there's an overwhelming preponderance of concentration of resource industries in these stock markets. And so increasingly, what you have is you have this process by which you have this duality of resource extraction combined with the notion of the financialization of African resources through stock markets available to the wealth funds of the world without any restriction. And so it gives the opportunity both for wealthy to gain access to it and for FDI to quickly liquidate their assets invested in Africa through the stock markets. So take, for example, Ghana. Ghana has 37 stocks listed on its exchange. 2 completely dominate the stock exchange, Anglo Gold, Ashanti Limited, and Tullow Oil PLC. All other stocks combined are only 15% of the total market value of these 2 stocks. And of course, one of the largest parts of the portfolio, T. Rowe Price's African Middle East Fund, is in Anglo Gold Ashanti, something like 4.3% of the total portfolio. Now this outlines, I don't have a lot of time to go through this, but this kind of provides an outline of the huge amounts of capital account liberalization. So we know in Uganda, for example, there are no controls on inflows, no controls on outflows, no controls on equity, no controls on FDI. Same in Zambia. In other countries, some examples, just very minimal types of controls. Very, very few capital account restrictions. What is interesting is the kind of shock therapy approach that was taken. So we know in Uganda, all this was done at once overnight in 1997. It was phased in other places over periods of time. I don't have a lot of time to do this. But you can see country after country, there has been this movement towards capital account liberalization in Africa. So what are the implications of these flows and their perversities? Well, we can see that this is sort of the history of FDI inflows to sub-Saharan Africa between 1980 and 2002. And what you see is interesting period. This is a heavy period of structural adjustment. And Africa became very marginalized from FDI and then began to take off again after the kind of mid-2000s. Huge amounts of inflow of FDI recovering to historical highs as a proportion of total developed countries. Of course, there was an explosion of FDI in the world in developed countries and in developed countries. So what you had then is this marginalization and a resurgence almost all entirely due to oil and other resource-focused FDI. So if we look at 85 to 85 period, 52% of total FDI excluding South Africa went to four oil exporting countries, Angola, Nigeria, Cameroon, and Congo. In 1985 to 90, even more concentrated in 2 countries, in Nigeria and Angola, the 2 biggest oil producers. In Africa, similar all the way up to 57% in the 92 to 97 period. And then recovery of the share up to 8.5%. And the vast majority of the increase has been inflows of a bunch of the traditional oil exporters, Nigeria and Angola, and the arrival of new players in oil in Sudan and places like Sudan and Equatorial Guinea. So if we look at the actual increase between 2005 and 2005, 78% of the 16.1 billion increase of inflows to non-South African, sub-Saharan African countries went simply to oil-producing countries, the 4 countries that are the major oil producers. And it has had really a profound effect, and another resource emphasis, such as Tanzania, which has discovered gold. Gold, for example, in Tanzania has gone from 1% of exports in 1999 to currently around 40% of exports, a huge FDI flow into gold exports. Now, it's really had a profound effect in the nature and the structure of these economies, as they've become much more extractive, very much back to kind of the colonial structures that we know about in Africa. The problems with FDI flows is they're not a very good source of development. In general, we know they do not stimulate broad-based development, they do not expand many employment opportunities, and they do not diversify export, they do not often lead to meaningful transfer of technology, basically, and due to the structure of taxation, a very low taxation encouraged by the World Bank, the revenue generated tends to be very, very low. So in Tanzania, they take about 3.5% of the value, that is all, out of the gold sector. So while gold prices has risen dramatically, it hasn't had much of an effect except for the small number of people getting access to the mining sector. So what's happened now if we look at the structure of the exports sub-Saharan Africa? So what you find is that fuels are basically we're running around 40% in 1995. They hit a peak in 2008 at about nearly 3/4 of total exports in fuel. Other primary commodities altogether, it's really back to colonial periods. To get these kind of figures, you've got to go back to the 50s and 60s, early 60s to get 91, 92, 93% of all exports in primary commodities coming from Africa. Of course, what has happened is manufacturing, which was already low by international standards, has largely collapsed as a proportion of the total. And so what's happened is manufacturing goods have declined proportionally. And we look at the structure compared to economies, one, Southeast Asia, which had a heavy resource extraction in its history, was able to do good things with it, versus sub-Saharan Africa. And you find what's happened is in agriculture has declined in Southeast Asia. Sub-Saharan Africa has stayed fairly constant. You really haven't had a green revolution or dramatic transformation in productivity in Africa. Per capita food production today is less in Africa than it was in the 1970s. Sub-Saharan Africa, we've had, of course, a huge increase in mining. So it's now, as 2008, up to 27% of the value added. And in mining, what we've seen is it's gone up also in Southeast Asia, but it contracted considerably relative to historical standards. And of course, manufacturing in Southeast Asia has really taken off, basically. And there's a whole other talk about why manufacturing can be potentially much more valuable than extractive industries. And then what's happened is manufacturing, which is a big source of urban employment. And of course, what you've got is the most rapidly growing urbanization of the world is in sub-Saharan Africa, something like 3.8% per year. And there are no jobs for a lot of these people. And so what's happened is a huge growth of informalization with all its health consequences in these countries. And so what's happened is manufacturing as a proportion of value added has basically collapsed in sub-Saharan Africa, like the 6.6%. I think they get back to the 1950s, so it's something that's that low. Development indicators also are very problematic. You've had a decline in revenue today. State proportion of expenditures in sub-Saharan Africa has actually fallen down to around 12% from 20%. And so there's simply not much in the way of employment opportunities in the states. They're not putting out the kind of public goods that are really necessary. If we look at what's happened, is we see that in sub-Saharan Africa, the real GDP per capita actually collapsed in the 1980s through the 2000s, largely because of neoliberalism and structural adjustment, and started rising again largely because of the resource expansion. Over this time, the GDP per capita of Southeast Asia has been able to grow quite dramatically. So at one time it was below sub-Saharan Africa, and today it's 3 times sub-Saharan Africa. What you've had also is some growth in a lot of health stuff. And you see a lot of growth in life expectancy in Southeast Asia, and stagnation in sub-Saharan Africa, still in the 40s. And infant mortality rates, which have also declined quite dramatically in Southeast Asia, have been fairly stagnant in sub-Saharan Africa. And so there are other areas we can talk about. I'm sort of giving a bit of a spattering of some of the other dimensions of global finance. And what we find, of course, is that foreign bank ownership, there was a very heavy relaxation of foreign bank ownership regulations with a big impact on the composition of banking in Africa. So you had a very rapid foreign takeover of banking, basically assets, where the bank and fund dominated policy. And typically what happened, I sort of wrote a paper, this came to the journal a couple of years ago, what happened basically is the financial liberalization episode in Africa, like so many other places, led to one financial collapse after another. And so the World Bank started coming up with a new standard which said, no, we shouldn't have the state take it over, let's hand it over to foreign ownership. And that will provide sort of in some ways import the norms, the organizational structures, the capacities, because the regulatory structures are weak in Africa under the private sector. And so what we need to do then is hand it over to the foreign banking sector. And that has helped financial stability. But unfortunately, it has come with enormous costs. Because what has happened in essence is that in the majority of these banks, you increasingly get holding of secondary reserves. There's a real lack of interest in financing private sectors. And there tends to be a large export of foreign assets out of the country. I'll show you some statistics just in a minute. But basically what happened is that, so this was the best route from their perspective to deal with the financial crisis. And so you've had a huge increase in just a handful of foreign ownership in the degree of control in a lot of countries like Uganda and Zambia, up to 80% or so of the ownership handed over to foreigners by 2005. And the problem is this, is that you look at the asset structure of these banks and what you have in the non-crisis countries, to some degree much worse than the crisis countries, where you've handed over a lot to foreign banks. And what you find is a huge increase in the proportion of foreign assets to loans. In other words, in essence, you're getting, because of the capital account liberalization, the ability of these banks to ship local domestic savings outside the country for utilization of their accumulation strategies worldwide. And also what you have is, which is typically the case, an increase in the claims on government, building up the treasury bills, and at the same time, a decline, particularly in the crisis countries, of the proportion of claims going to the private sector, simply declining in their loans to the private sector. An additional dimension of global flows, which is perverse, is the issue of reserves. Now we know, particularly in Latin America and elsewhere, it's been very strong. It's very well documented that Latin American countries have partially been able to deal with this crisis because they haven't had to go to the IMF, because they built up huge international reserves as a mechanism to deal with the crisis rather than have to go with the austerity measures imposed on them with the IMF. So it's been a process of self-insurance. African countries also got into self-insurance, basically. But there are huge opportunities, costs associated with that. So we look at sub-Saharan African reserves, ratios, and excesses. And what I use for excesses is calculating anything above 3 months, basically, of imports in your reserves as being excessive in the kind of best of all worlds. And so what we see is a huge increase in the number of reserves abroad. Basically, so the proportion of reserves begins to get up to nearly a half, just prior to the crisis, relative to imports, close to 6 months of reserves relative to imports. With huge growth in the amount of excess reserves. And so the problem is, in this perverse world, where is the reserves held? Reserves are held in Western banks. They're held on Wall Street. And in some cases, like in Nigeria, they lost quite a bit of it as a result of the collapse of Wall Street over this crisis. And so, based on that, you can calculate a rough measure of excess reserves, which went from something like 10.9 billion in 2000 all the way up to 75.3 billion in 2009. There's something like a 7-fold increase in the level of excess reserves. And it's not insignificant. If you do a measure of the total value of gross capital formation in Africa, it comes to something like 40% of gross capital formation, and $90 for every man, woman, and child in sub-Saharan Africa. What this means basically is in countries where you have per capita incomes of $300, $400 or less, that's a huge amount of money, in which you can do so much with that money if you're using it, say, for public goods, or even providing loans to the private sector. So in Nigeria, one of the more extreme cases, in 2008, the excess reserves were 270% of gross capital formation, $315 for every man, woman, and child in Nigeria, where 67% of the population lives on less than $1.25 a day. Massive, massive opportunity costs in this global financial system with this stuff sitting on Wall Street. I had a huge argument with Charles Salado a few years ago in Addis Ababa. I said, why the hell, and this was during the Bush period, why the hell are you financing Bush's war in Iraq by parking your money in Wall Street and buying U.S. Treasury bills? You know, and so we had a big argument, how can I bring the money back, blah, 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 which is not hard to figure out, you know, and so Charles was eventually pushed out. But it was obscene to see this level of reserves with huge opportunity costs sitting in developed countries. Now, non-FDI flows, it's another huge problem. Basically, non-equity, non-FDI private flows, sub-Saharan Africa as a whole were very dismal between 1996 and 2001. What was happening during this period, during the crisis years of the 80s and 90s, up through 2001, you had net outflows, particularly from banks, that were simply liquidating their private loans to African countries. There has been a big rise, 2000, 2009. The first HIPIC country, Ghana, to get a bond market, but they paid ridiculously high interest rates to be able to do it. Large outflows again in 2009. What's noteworthy, though, is the tremendous volatility in recent years, with $22 billion swings between 2006 and 2008, and the usage of equity markets as a vehicle for capital export in 2008 and 2009. I won't spend a lot of time on this, but this sort of gives you the data, very negative, non-equity capital flows, basically. Some growth, you know, and you can see that the participation of Africa, very marginally negative, excluding South Africa, it's all about one country. Started getting some significant participation in 2007, but 2008, 2009, the combined amount was back to a negative outflow. The final category that I want to look at, and you know, I want to get through this quickly so we can open up for discussion, is the issue of odious debt and capital flow. Some very good work by James Boyce and Leonce Nakamura, basically about the huge amounts of debt outflow that's associated with the debt creation. What you see, of course, if you look at the debt tables, sorry to turn all this data at you, but what you have basically is a period in which you have, of course, massive, massive increase in debt. Basically, it was associated, much of it was official debt, bilateral, particularly huge growth in multilateral debt, with a shrinkage proportionally of private debt during this period. And so what you find then, so it's a huge increase of, you can see multilateral concessional debt, mostly from the World Bank, growing dramatically between 1980 and 1998. And then, of course, what you had is the huge increase by 1998. The debt-to-export ratio of sub-Saharan Africa was 360%. We know the IMF's rule of thumb is you cannot really export your way out of 2-to-1. Everybody knew that this was a whole game. Africa would never be able to pay it back. And so what they did is they got into the debt relief mechanism versus HIPIC, which focused on the reduction of bilateral debt. You can see the numbers shrinking over this period of time. And then, of course, also the multilateral debt relief initiative, 2004-2005, which found a way to reduce debt on multilateral concessional debt. You see the numbers beginning to drop, although it's kind of rising again. So they managed to get the shrinkage down and the ratios to much more manageable levels. But much of this debt, and that's what's so problematic, was associated with very problematic political regimes. And so people have talked about this legal category called odious debt, which is incurred by regimes and military dictators, often for their personal enrichment, rather than for the interests of the nation. We know Mobutu in Zaire was notorious for getting his IMF and World Bank money and the stuff disappearing. Pocketing and putting off in his bank accounts elsewhere. So what has happened, though, in this very perverse world of international finance, nations are held responsible for debt that they do not benefit from. And that's what we mean by odious debt. And moreover, the problem really is systemic, because associated with this debt creation has been massive capital flight. So the process that generates debt also fuels capital flight. So there are willing participants both within African countries and in the private banks in the developed world who generate large fees and interest returns on loans and deposits. And so international financial institutions have also gotten into this game because they've got to move money. The World Bank basically survives out of loaning money, not by sitting on their hands and holding on to the money. Ndukumana and Boyce examined data from 28 countries for the period 1970 to 1996. They estimate that every dollar of additional debt generated 80 cents of additional capital flight. Well, what is the relationship? They talk about 4 different types of linkages between loans and capital flight. One is what they refer to as debt-fueled capital flight, linkages to private individuals, kickbacks, ghost projects, diversion of funds, flight-fueled foreign borrowing, linkages to offshore accounts and then borrowing back, debt-driven capital flight, that is debt inflows raise motivation for foreign flight, taking advantage of temporary rises in currencies, and finally flight-driven foreign borrowing, capital flight driving the demand for replacement funds. So how much capital flight has occurred, and how does it compare to debt levels? Well, they further analyze it using a methodology. Basically, the starting point is the observation is that there's an enormous divergence between the balance of payments data on African countries and the data that comes from the World Bank's Global Development Finance data, mostly from the developed country sides. And so there's a huge disconnect between the two sides. So they start with changes in external debt and debt tables, add net foreign direct investment, subtract the current account deficit, subtract changes in reserves, add adjustments for export misinvoicing, positive signs indicate under-invoicing, add adjustment for import misinvoicing, positive signs indicates net over-invoicing, negative net under-invoicing, e.g. smuggling, and adjustment for unreported transfers. And so what they do is they do these calculations, basically, and comparing the accounts with different sources, making these adjustments. What they find is real capital flight through 2008, basically from, I think, 1980. And what you have then is a rise, a capital flight ratio overall to GDP of 80.8%. They then calculate using treasury bills what the interest rate will be over time, so that they have a figure up to 2008. And they measure the external debt. And what they find is that the next external assets, that there are more, there's something like 760 billion more abroad than Africa has borrowed through this mechanism. So it's a massive amount of capital flight embedded in the situation. There's been other measurements that come up with very similar kinds of figures. So Africa is not a net debtor to the rest of the world. They are a net creditor to the rest of the world in this system, with huge implications to the welfare. So just to conclude, basically from an institutional perspective, the challenge of finance really in poorly formed markets, developing countries, in a world of rapid global flows is really much more profound than whether you issue bonds or stocks, basically, etc., or bank lending as a source of productive investment. I would argue that, and I don't have time to develop this, is that financial flows can be seen as a series of domestic and international circuits that intersect among themselves in the real flows of commodity and productive resources. Institutionally, I would argue, each set of flows have their own internal concatenating capacities, incentives, norms, regulations, organizations, or what I've called elsewhere institutional constructs. Each flow then can be defined relative to other flows, which helps to give them scope, content, and meaning. The shift of any one institutional dimension of any flow, such as regulations or capital account mobilization, has huge implications to the nature of the intersection and interaction with other flows, and can then create the kind of perverse results that I have described. And what we have then is we have to think about new types of institutions in place to connect the financial real flows in the economy. But this is very, very difficult to do if the flows are being dictated by the wealthiest in the world for their own purposes of accumulation, aimed at maximizing income from an increasingly concentrated group of wealth holders in the developed world. Controls have to obviously be put in place and can take many forms, and we'll get into debates, big literature on tripwires, speed bumps, Tobin taxes, setting reserve requirements, restrictions on currency convertibility, etc. But the question really becomes, and let me close with some more concrete examples. The question really becomes the big problem in Africa. When I was lecturing a bit on this earlier today in the brown bag, is really a huge lack of investment in the kind of public goods necessary for agricultural production to increase. The same can be said on the industrial side. We've seen largely a collapse of manufacturing capacity, manufacturing exports in sub-Saharan Africa. So let's take the example of industrial policy, this horrible word that mainstream economists don't like. State financial organizations, in my view, in a mixed economy are absolutely essential. At the heart of many of industrial policy instruments are basically state capacities to direct financial flows in this world into real productive private sector enterprises. They do not happen automatically, particularly with these very poorly operating markets in sub-Saharan Africa. I mean, as Stiglitz has pointed out numerous times, in the poorly developed financial markets, there will be a profound difference between the social value of lending and the private benefits of lending. Banks, if you leave them to their own devices, and this is when I did a study with Peter Lewis on the whole political economy of financial globalization in Nigeria, we published a book in 2002 on this. If you leave them to their own devices, they gravitate to finance projects which are short-term, have lower working capital, have lower risk, avoiding what are much more developmentally enhancing projects like manufacturing, which have much higher working capital needs and much greater risk with great positive developmental benefits. So states have to begin to think about creating incentives to encourage bankers to support loans which have greater social and economic benefit. And the very early stages, basically, before bankers can be left to their own devices, you have to see and emphasize things